Nedbank reported a 26% rise in first half profit on the back of falling bad debt charges and growing revenue from fees and commissions. Diluted headline earnings per share rose 26% to 600 cents in the 6 months through to the end of June. And joining me at the desk to drill into the numbers now is the bank's CEO, Mike Brown. Thanks so much, Mike, for joining us this afternoon.
Pleasure, Alishia.
Well, taking a look at the figures, that's exactly what it's come in at, pretty much just above the midway point of your trading update released last week, where market consensus is for banks to show scant earnings with a decline in bad debts largely fueling improved results. Your assessment of the half year so far?
I think we had a strong half year result that we put out there today. We have benefited from the reduction in bad debts. Our credit loss ratio has fallen now to 1.21% from 1.46 a year ago. So that feeds quite strongly into the bottom line. Pre-provisioning operating profit was up around 10%, so that gives you an idea of the effect of impairments benefiting in the bottom line. I think the other important thing was our growth in non-interest revenue, up 16%.
Yeah, let's take a look at impairments and how you're actually managing it. Because like you said, your credit loss now stands at 1.21%. Is it a matter of managing impairments and non-performing loans better, or is it just a feature of a decline in growth on the loan front?
No, so I think it's both a better economic environment, and we know that it's still very difficult out there for both the retail side and the wholesale side, but it is better than it was in 2010 and certainly better than it was in 2009. So we do get a benefit from an improved economic environment and lower interest rates. But we've also put a lot of effort into our collections environments, particularly in retail, and that's starting to feed through.
I had a question come through from a market watcher earlier today when I was chatting offline, and his question was how you're managing properties specifically in possession, because, with the increase in rates and taxes, on the one hand, you've got to, consider that. It's been a contentious issue in the past. And, what the question is, what does it cost to actually get that property back or take that property back?
It certainly is very expensive to take properties back in, and that's always our least preferred route in any circumstances. And in fact, through restructuring accounts and working with our customers, we've probably kept in the last year or so more than 10,000 people in their homes. Pleasingly, our properties in possession actually reduced by 25% in the first 6 months of this year.
How do you account for those costs? Is it taken into those impairment charges?
Yeah, absolutely. So when an account goes into default, which is what happens before it gets into a property in possession, we would raise impairments on that. And at the moment, our impairments on our defaulted book probably sit at about 26%.
Yeah. So management coming through on that front, you highlighted as well that we've seen fees and commissions rising as well. It's a figure that the market's been looking out for. Question is, how sustainable is the kind of growth we've seen on that front moving forward, making money from transaction, given that it's a very difficult market you're catering to and the competitive environment is certainly increasing as well?
So, we certainly think we can continue to grow non-interest revenue in double digits. And some of that is Nedbank specific. We've spent quite a lot of money over the last few years on our electronic banking platforms, and we've been able to roll out some new product functionality there. So we've seen record growth in our electronic banking volumes in the first 6 months of this year. We also bought the bank assurance joint ventures from Old Mutual probably 2 years ago, and those have also come through very strongly. So we've seen 30% growth in insurance revenues, and we've had good numbers of client increases. Nearly 100,000 new customers, primary customers in our retail business, over 600 new primary electronic banking customers in our SME environment. So all of that, I think, does put a degree of sustainability into our non-interest revenue growth.
I asked a question because I was listening to a very interesting conversation last week where, an industry expert was saying with banking becoming simpler and easier, and leveraging, for example, of mobile channels, of internet banking as well, many saying that as that new technology comes online, and how you interact with consumers shift as well, banking charges will come under strain. It's going to become cheaper. Are you going to then be driving for volume growth to balance that off?
I think that's exactly right. If you look at our bank charges on a given basket of transactions now are still at the same levels as they were in 2005. So we've had no real increase since that date, but what we have seen is strong volume growth. And something like our M-Pesa product that we launched together with Vodacom has now more than 200,000 subscribers.
Okay, taking a look at it, we've had, you know, the likes of First Rand, the like of ABSA move to the lower end of the market, and that's exactly it, you know, in the chase for volumes moving forward. Are you following suit, and is it a worthwhile market for Nedbank specifically to be targeting at this stage, where we've also had Postbank emerging on that front?
Yeah, so we certainly think it is a worthwhile market both for us to target, but it's also the right things for banks to be doing for society more broadly. If we look at our business at that end of the market, we have a very strong personal loans business that we've been in for probably 10 or 15 years. That grew its book by 25% in the first 6 months. So we've seen decent growth there. And then we've recently launched an exciting new product in the entry-level banking space called Kiona, and that's also had some great uptake in the last couple of weeks.
How do you see this changing the profile of Nedbank within the South African banking sector? Because Nedbank very much thought of as a high-end bank.
Yeah, so I think we will always be an aspirational brand, but we are stretching that brand to be a bank for all South Africans. And I think the growth that we're seeing in our middle and mass market products is evidence of the fact that the brand does stretch very well.
Well, while we've got a battle continuing, well, it seems so on the surface anyway, in terms of reining in costs. I mean, you've had your expenses rise R1 billion from 7.87 billion last year to 8.84 this year. What kind of battle are you facing in that regard?
Yeah, we think that we've been pretty disciplined in managing our costs over an extended period of time, but balancing that with the need to invest in the franchise. So you'll see over the last 12 months, we've rolled out more than 100 new branches and outlets and added more than 400 new ATMs to our distribution network. So you can't do that without increasing your cost base. But what we watch very carefully is the rate of growth of costs versus the rate of growth of non-interest revenue. And if you looked in the data now, you'll see non-interest revenue up 16 and costs up about 12. So we have kept that jaws positive.
Yeah. Taking a look at spending on IT systems specifically, how much has been invested going down that route, or do you need to still provide for that down the line?
So we invest in our IT systems consistently over time. We probably spend somewhere around about 800 million rand of cash flow every single year on enhancing and updating our IT systems, and we will continue to do that. We're on quite a big rationalization and consolidation journey from an IT perspective to take us into an environment that is both cheaper to operate, but probably more importantly, enables us to be more agile, to innovate faster for our customers.
What's your outlook moving down the road for the next half of this year, Mike? Because, you know, with all the rumblings we've heard out of Europe as well, HSBC included in that, cost cutting coming through in a big way. It's even rumblings of corporate activity that seems to at this stage be simmering down quite a bit.
Yeah, so I think the overall economic environment is still very fragile. The US and the EU have significant debt problems. We heard Bridget talking about that earlier. And to correct those debt problems is not a short-term solution. It's going to require increases in tax rates and severe spending cuts. So I think we're going to see a period of very slow economic growth globally for an extended period. The South African economy is in a slightly different place, but we are tightly correlated to global growth. So I think we're probably going to see around about 3.5% GDP growth this year, and that's down from 4.8 in the first quarter. So we are seeing a slowing.
Translating for what in terms of Nedbank's growth?
So I think that we will continue to grow earnings over the full year. We have a medium to long-term earnings growth target of GDP plus CPI plus 5, so let's call it 5% real. So 3.5 GDP, CPI at around 6 plus 5 on top of that. You've got somewhere around 14 to 15% growth. We've got 26% growth in the first half, so I think we should be able to beat that 14 to 15% growth over the full year.